Welcome viewers to Bodhi Unified Flow. Here we simplify complexity and amplify performance. You're tuning into our explainer on the buy, hold, and sell blueprint, covering equity, mutual funds, REITs, and gold ETFs. Today, we're zeroing in on part 7, exactly when to buy gold ETFs as the ultimate crisis hedge. We're going to break down the exact institutional triggers, when to buy, why to buy, and exactly how to execute those moves when the rest of the market is literally in a state of panic. Look, this isn't about emotional trading, right? This is about structured mathematical asset allocation. Let's get into it. So here's our game plan for today. We'll quickly hit our learning objectives, dive into gold as a crisis hedge, unpack those macroeconomic buy triggers, navigate crisis liquidity, explore dynamic risk parity allocation, and then wrap up with our summary and references.
All right, Section 1, Intro and Learning Objectives. Let's set the foundation.
You know, in financial markets, the difference between a retail trader and an institutional investor is really just a fundamental difference in psychological wiring. By the end of this session, you're going to completely elevate your mindset. You'll know how to spot macro buy triggers way before the crowd catches on. You're going to master how to navigate crisis liquidity exactly like the big players do, and you'll learn how to weight your portfolio using objective risk parity formulas. Basically, we're aiming to completely neutralize timing risk here.
Let's move right into Section 2. Gold as a crisis hedge. This is all about defensive power. Okay, think about this. When we face sustained bear market declines, we're talking drops of 20% or more, standard growth assets just fail. Take stagflation, for example. That's that dreaded economic regime where growth stalls, but inflation is just running hot. Notice how US equities get compressed here, actually delivering negative real returns of minus 1.54%. Why? Because tightening monetary policy squeezes corporate lending margins and totally dampens consumer demand. But look at gold. Meanwhile, gold delivers an absolutely staggering 22.14% real return. It steps up precisely when your core capital appreciating engines are sputtering out. So how does this actually translate to real-world panics? Cast your memory back to the June 2016 Brexit event. Man, that was a moment that completely shook global stability. Looking at the data right after the verdict was announced on June 24th, there's a massive upward spike. The logic driving this is incredibly predictable. Whether it's Brexit, a migrant crisis, or major geopolitical tensions, institutional capital immediately sprints toward the ultimate safe haven asset, an asset completely decoupled from corporate earnings and backed by a strictly limited global supply.
The defensive nature of gold during these systemic shocks? It's literally undeniable. Just look back at the global financial crisis from 2007 to 2009. The S&P 500 lost over 55% of its value, over half. Yet gold, it rallied nearly 24%, acting as this incredible strategic insurance and recovering to pre-crisis levels years ahead of equities. But check out the COVID-19 crash in 2020. The S&P dropped about 34%, and gold actually dipped 3.6% right alongside it. Keep that specific anomaly in the back of your mind, okay? Because we're going to break down exactly why that happened, and more importantly, how you can exploit it in just a few minutes.
Which brings us to Section 3, Macroeconomic Buy Triggers. We need to look at the quantitative data signals.
See, gold's main vulnerability is actually pretty simple. It doesn't yield any interest. Because of that, your absolute clearest buy trigger is the trajectory of real interest rates. When real yields fall, or better yet, turn negative, the opportunity cost of holding non-yielding bullion just completely vanishes. And boom, its defensive appeal skyrockets. The cool thing is, we can actually front-run those yield drops using labor data. For instance, back when June U.S. non-farm payrolls printed an addition of only 57,000 jobs against an expectation of 113,000, that was a massive deceleration. That single data point immediately shifted the CME FedWatch interest rate projections. It literally dropped the probability of a Fed rate hike from 65% down to 50% in an instant. A cooling labor market caps treasury yields and weakens the dollar. And guys, that is your quantitative green light to accumulate.
Okay, Section 4, Navigating Crisis Liquidity. Let's talk about the actual execution realities. So, during extreme market stress, on-screen liquidity, the immediate bid-ask spread you actually see flashing on your exchange, it looks terrifying. Market makers naturally pull their quotes to manage volatility, and that causes spreads to widen aggressively. But listen, do not be fooled by this on-screen panic. The underlying liquidity of gold ETFs is incredibly deep. It's supported by what we call Authorized Participants, or APs. These are massive institutional players that create or redeem ETF shares in huge blocks directly with the fund issuer by exchanging physical bullion. This arbitrage mechanism ensures that even when your screen is screaming illiquidity, the actual underlying market remains highly resilient. So you can still execute remarkably close to the fund's net asset value.
Remember that slight dip gold took during the 2020 crash that we talked about earlier? Well, here is your exact execution playbook to exploit that phenomenon. Step 1, observe. In a severe, rapid crash, highly leveraged institutional portfolios get hit with massive margin calls. To generate urgent cash, they are forced to liquidate their most liquid and profitable positions. And unfortunately, that often includes their gold ETFs. This creates a brief, mechanical correlation breakdown where gold and equities actually fall together. Step 2, wait. Let that acute initial liquidity squeeze happen. Please do not try to catch the falling knife on day 1. And finally, step 3, accumulate. You want to buy your ETF units right at the peak of the squeeze, just before central banks swoop in to deploy quantitative easing or rate cuts. Once they intervene, gold violently separates from equities and launches right into a secular bull market. It's a beautiful thing.
Moving on to Section 5, Dynamic Risk Parity Allocation. This is all about mathematical sizing. Look, institutional managers don't just guess percentages, right? They use rigorous math. The risk parity formula dictates that the targeted allocation weight for an asset in your portfolio should be mathematically inversely proportional to that asset's forecasted volatility. Put simply, if you're blending gold with highly volatile assets like equities or some wild alternative investments, gold naturally commands a heavier weighting to balance out the overall risk contribution. Typically, if you're looking at a standard retail portfolio, a structural allocation of around 5 to 10% is absolutely enough to noticeably dampen volatility and limit your downside risk. This ensures that the compounding process of your core growth assets remains completely uninterrupted.
Finally, Section 6, Summary and References. Let's lock in those key takeaways.
To quickly summarize our blueprint today, gold is a mathematically proven stagflation hedge. Your execution triggers are falling real yields and cooling labor data. You now know exactly how to exploit margin call liquidity gaps during the initial phase of a crash, allowing you to buy in at a massive discount. And finally, you know to use risk parity math for optimal, totally unemotional position sizing. Basically, you are no longer just reacting to market panics, you are systematically prepared for them.
On screen, you'll see the specific references and institutional research papers we cited in today's explainer. I highly encourage you to explore these to really deepen your mastery of market microstructure and asset allocation. Thank you so much for joining me today at Bodhi Unified Flow. But before we part ways, I want to leave you with one critical question. Looking at your own current allocations right now and considering the macroeconomic data we just covered, is your portfolio truly insulated for the next macroeconomic shock?